Okay, in this chapter, we're going to look at several things. We're going to talk primarily about profitability. But hopefully, when we're done with this, you'll understand a little bit about the differences between efficiency and effectiveness, how to distinguish between profit and profitability, the differences in types of profit, understand how profit margins work, understand a little bit about what's referred to as the break-even point, right? How much business does a company have to do before they actually start generating profit? We're going to talk about this break-even chart, right? We're going to talk about how it's created. We're going to talk about some leverage questions. In fact, in the end here, we'll also discuss some other types of ratios, if you will, the degree of operating, financial, and combined leverage, and how they are calculated. And we'll talk a little bit briefly about some bankruptcy issues. So let's go ahead and get started talking about the differences between efficiency and effectiveness. Efficiency is getting the highest possible return based on the assets that you have purchased. Effectiveness is just accomplishing a task. They're different things, if you will. So we want companies to be very efficient. We want them to be able to create returns on assets that they have purchased for the company. So profit is the start of this number. It's an absolute number. It's an accounting number. So the accounting profit is typically what's at the bottom line of the income statement. It's created by the accounting mechanism, the system itself, right? It's the bottom line, right? Entrepreneurial profit, though, is the amount that's earned above and beyond what that entrepreneur could have earned if they had chosen to invest their money in some other enterprise. In other words, entrepreneurial profit is essentially an opportunity cost question. So there's a couple of videos here that talk about entrepreneurs, profit versus non-profit entrepreneurs, and how to develop wealth. I think both are relatively short videos. They're not very long, but I think they are insightful into how businesses ultimately operate and how profits are really earned. So again, profitability is measured many different ways. We can look at it relative to sales. We can also look to it relative to assets. In this case, they're talking about return on investment or return on assets. If you remember a previous video, we also talked about something called the basic earning power of the company. So earning power is defined two ways. Our ability to generate income based on the revenue that it sees. This is net profit margin. And also our ability to maximize sales based on the ratio, on the assets that we've purchased. This, relatively speaking, is what's referred to as the total asset turnover ratio. So earning power is net profit margin multiplied by total asset turnover. And if you multiply these, you see that net sales is going to divide out. So we end up with net profit divided by average total assets. Again, this is a ratio that talks about, relatively speaking, the earning power of the company. The combination of the actions of the company, the efficiency with which they use the assets, and the actual product, the outcome, which is profits from actually the use of those assets. So again, bigger numbers are better here. They implies that companies can generate more. Who gets the more? Who gets the ultimate output from the company? And of course, that ends up being the owners of the company. So let's talk a little bit about break-even analysis. We would like to find that point where profits are zero. that really is kind of an uncomfortable kind of definition because you never really want to know that. But another way to ask this question is, how much stuff do I need to sell just to get to break even, just to get to zero profit? Because if I say, on a really good year, I can sell 5,000 things. And then I find out that I need to sell 6,000 things to break even, then I have a problem, right? So this number gives us an idea of how well the company is performing and how good the company can perform or might perform. So we have a lot of concepts here all at once, right? So the break-even quantity is the fixed cost of the company divided by what's referred to as the contribution margin. The contribution margin is price minus variable cost. So again, this idea of contribution margin is critical. For every unit that you sell, how much profit is left to cover the rest of the costs of the company and provide profits? Fixed cost is the bottom line number. So how much fixed cost is covered by every unit we sell? Again, the bigger the number here, the harder it is, right? You're setting a higher level just to get to zero. So let's look at this toy truck company, right? We need to figure out what the annual fixed costs are. Now, the way they give us this information is they give us fixed costs here, but they're not all in the same payment basis. So you do have to calculate the actual total costs, right? So if you take the time to do this, right? 2,000 times 12, 5,000 times 12, plus 7,000, 1,500 times 4, right? Plus 3,000. If you add that all up, it comes to about $100,000. The variable cost per toy truck created, when you calculate that, it's roughly $6, right? So the idea here is, if this is our cost structure, what is the break-even quantity for this business? So again, if the fixed cost, this should be fixed cost. If the fixed costs are $100,000 and variable costs are $6, if the price of the car, so if we charge $10 per truck, what's the break-even quantity? Again, 100,000 divided by 10 minus 6 or 4 is 25,000 units, right? So that means what? If we sell 25,000 units, and if you want to do the math, knock yourself out, but 25,000 units times $10 is revenue. 25,000 times $6 is the variable cost of the units. And then you have 100,000 as a fixed cost. If you calculate that out, you'll end up with zero profit. What if we could increase the sales price to $10? If you increase the sales price, you will decrease the break-even analysis. So we actually have a spreadsheet that's available that you can use called the break-even analysis spreadsheet. In this case, again, you can put the line items in here, right? You find out the per unit cost, $10, $6 is variable cost. Here is our fixed cost per unit of operations. Now, I've also added some other things here. I've added some units of production. How much are we actually producing? What's the interest expense? And in the end, at a 21% tax rate, we can actually start to calculate some income, etc. But the EBIT for this particular process is around $299,940. The break-even units, as we said, were 25,000 units. Now we can also calculate the break-even based on sales. We'll talk about that a little bit later, but you can see here that if we sold $250,000 of inventory, then we would also be at a break-even point. If you look at the graph, you can see here that the revenue curve, that's the blue curve, obviously increases the more units we sell. The total cost also increases the more units we sell. And it is a combination of the fixed cost plus the variable cost per unit. And you can see that there is a point where the revenue exceeds the costs. That obviously this is a profit area up here, and this is a loss area down here. Okay? So again, we would like to obviously hope that our production, our units that we're selling, is greater than the actual break-even point. Now this contribution margin, again, I mentioned earlier, is very important. It talks about how much profit is generated per unit. Now, after we've covered all of the fixed costs, right? In this previous example, if we sold 25,000 units, we would be at break even. All the fixed costs are covered. What if we sold 10 more units? What if we sold 25,010 units? Those 10 units above the break-even point all have a profit, right? The profit is the contribution margin. So after you get beyond the fixed costs, after they're covered, you have a very straightforward profitability per unit. In this case, it would be $4 per unit. You'd make $40 in earnings before interest and taxes if you sold 25,010 units. So again, it is a very important concept that helps us make very quick kind of our analysis of some of our profitability. I mentioned earlier about the break even in dollars. It's just the fixed cost divided by 1 minus the variable cost percentage, right? So this would be different. For a retail company, it's the cost of goods sold divided by net sales. For a manufacturing company, it's going to be the variable cost of a unit that you sell, right? So it could be different numbers for different industries. What if we want to figure out how to earn a certain amount of money? So let's say a business owner wants to earn $100,000. If you take the fixed costs plus $100,000 and divide that by the contribution margin, that will tell you how many units you have to sell to cover the expenses of the business and generate the profit level that you want. So you can also do this by break even in dollars as well, right? So again, as an owner, this might be kind of important to understand how easy is it going to be for you to generate the profits that you need to live on. Changing gears a little bit, let's now think a little bit about leverage, right? Leverage is the use of fixed costs to run the company. So fixed costs can be relative to operations, or it can be relative to financing. So interest expenses that are paid on debt is the fixed cost of financing, right? And a company that has lots of plant and equipment is going to have a lot of fixed costs relative to operations. So again, we need to have an understanding of this relationship of leverage. And we have two basic formulas that we can calculate from financial statements. The degree of operating leverage measures the business risk of the company, right? It's the percent change in EBIT, operating income, divided by the percent change in sales, right? So this number, the bigger the number, the greater the business risk of the company. The degree of financial leverage looks at the financing question, the amount of debt that we've borrowed. This is the percent change in earnings per share divided by the percent change in operating income. So again, the bigger the number Relatively speaking, the greater the amount of financial risk that the company is taking. Now, before we take a step further, let's think about this. Operating leverage measures business risk. Business risk is essentially chosen when you decide what industry you're going to work in, right? I mean, I don't think you could see starting a car manufacturing company and only using variable costs. There has to be fixed costs. In fact, in that type of operation, the fixed costs are huge. Relative speaking, think about some service industries that don't have any, to speak of, fixed costs of operation. Again, the business risk you choose is basically decided when you choose the business. Financial leverage, though, is something that you absolutely choose. You choose whether to borrow money or not borrow money. You choose to relatively change the debt structure of your company by making decisions. We can combine these two concepts into what's referred to as the degree of combined leverage. And this is just a product of the degree of operating leverage times the degree of financial leverage. Again, this number reflects the relative leverage, the relative risk of the decisions that you've made in the company with respect to fixed costs of operations and the fixed costs of financing. So again, if we look at this ratio that we've been able to calculate from the break-even, this comes from the break-even analysis worksheet. Again, you can see a basic with we've input some numbers, and to the right here, you can see the degree of operating leverage from this company with the $10 price per unit is around 2.67. The degree of financial leverage, 1.09. So relatively speaking, they have low financial leverage. It cannot be less than 1.0. So they really haven't borrowed all that much money. So the total leverage of the company is 2.91. So how can this company increase the returns that go to investors? They need to figure out a way to increase the riskiness in which they're working. Can they increase operating leverage? That's a little bit harder to do than to just, quite frankly, borrow some more money. Another way to look at this ratio is, instead of using a very simple ratio to calculate this, you can actually use the ones that come from the financial statements. So here, if we know beginning and ending earnings per share, beginning and ending EBIT, and beginning and ending sales, we can utilize these formulas that we had above here. So for this company that I have listed here, the degree of operating leverage is 2. The degree of financial leverage is -2. Now, this is what happens when you use real data, because sometimes numbers don't always increase. Sometimes they decrease. And you can see here that the sales number has decreased from 10,000 to 5,000, and EBIT has decreased from 2,500 to 0. So in this case, what we find is that the degree of total leverage is negative. Again, let's think about the absolute value here. The absolute value says that this company, relatively speaking, is using a certain amount of leverage to generate their operations and to buy their assets. So this company would have higher leverage in total than the other company over here. So again, how we utilize this number and how you analyze what goes on in the company, again, that's just that's for a little bit of a more advanced course to understand the complexities of the decision-making process for a company. So to close this chapter, let's think a little bit about bankruptcy, right? There are really 3 kinds of bankruptcy. there's what's referred to as Chapter 11 bankruptcy. This is essentially when we're going to ask the courts to give us some protection. We want to reorganize the company, if you will. So we're going to make arrangements with our creditors. Maybe we'll extend payments, increase interest rates, etc. But we'll make an arrangement. But while we're working on that, we want the court to protect us so that our creditors don't force us into insolvency. Chapter 13 is what is reserved for individuals, right? It's a lot simpler than the Chapter 11 process, but Chapter 13 allows us to rearrange our debt, but at the same time give us some sense of protection while we're making these arrangements with our creditors. Chapter 7 bankruptcy talks about how we just liquidate the assets. We could do this for both individuals and you could do it for businesses, but essentially we would sell all of our assets and then make payment to all of our creditors. What happens if there's money left over, or if we still have debts at the end? At the end, those people that didn't get paid just don't get paid. So again, there is a video here that talks about bankruptcy and some of these issues. I think historically, there have been some acts that have been come from Congress, basically thinking about bankruptcy abuse. If you think about, there are people who have just run up tremendous amount of debt and just says the reason they do that is to buy all of these things and have these assets, and then they just declare bankruptcy. And that's their modus operandi, right? They get out of bankruptcy protection, right? And whenever they can start to borrow, they start to borrow again. They borrow way too much, and then they go back into bankruptcy, and it's a cycle. So again, one of the challenges here with the new act is it makes it much more difficult for individuals and businesses to declare Chapter 7, right? There is now a means test to determine if Chapter 7 is effective and warranted, or if it is abusing the system. So again, there are some questions and issues. I don't know if you are familiar with what's referred to as the homestead exemption, but essentially one of the rules is, if you're a person, is that through bankruptcy you cannot lose your home, right? So somehow the mechanism is in place to rearrange payments, etc., so that in bankruptcy you wouldn't lose the value of your home. So again, that is bankruptcy. There actually is a video on bankruptcy. There's also a video here very quickly on personal bankruptcy. We'll probably, if you're in the class, we'll probably talk about these in a little bit more detail. But that is the end of the chapter on profitability.